Happy Friday, everyone, and welcome back to Open Exchange TV. We're here today for our Friday musings with Jay Pelosky. How are you, Jay?
I'm good, Scott. And I'm telling you, buddy, I'm looking forward to the day when we have this session and you're not told to tilt your camera down.
Yeah, well,
And when is that going to happen, buddy?
I'm just blaming Bresney in the background. No one else says it.
I love it. It's like my Friday is hearing you be told to tilt your camera down. That's how my Friday is, buddy. I love it.
So, Jay, it's been an interesting week in the market. So it's just up, down, down, up, up. Looks like we've got a good day today. Like it's been hopefully will be an up week for the market, but there's no clear trend that seems to be coming up. Maybe up, but I'm not. Is there any confidence in it? Let's talk about the trends that you're seeing.
Well, you're right on it, Scott, as usual. Because remember, we wrote our last monthly extrapolation and beyond, and we talked about how extrapolating the trends have been the right course of action, but that extrapolation is coming, we believe, to an end. And then we wrote about two-sided markets in our musings 2 weeks ago, talking about the very thing you just discussed: stocks up, stocks down. That's better than stocks just going down, right? So we've continued to extrapolate the trend of ever higher interest rates. I think U.S. Treasuries, the 10-year, has sold off for 13 weeks in a row. We see the same thing impacting the foreign exchange markets, with the dollar yen blowing out every day for 13 straight days. Looks like we just had a little BOJ intervention this morning, but that's been another trend. So bonds drive currencies, both of them drive stocks. And what's interesting is the two-sided market, which comes about, we believe, from the impact of earnings, right? So that was what we wrote about last week. Remember, on to earnings. And so now we have a situation where rates would be pushing stocks down if it weren't for earnings holding up better than expected, leaving us in this choppy environment, which technically, I think the technical analysts would call it basing, which is, again, the prelude to a turn. So I think the really important point is that we're kind of in that transition phase. Stocks are not going down, even though rates are backing up. Think about it. When the S&P bottomed back in June, the 10-year was at under 350. It was around 348. Okay, today, June, July, August, September, October, 3 or 4 months later, we're at the 10-year at 430, so up almost 100 basis points, and stocks are still at their same level. So we've had a lot of aggressive rate tightening, and stocks have been able to handle it. And you've even seen it just month to date. I just took a look this morning. Month to date, Barclays Ag is down 3%. The S&P is up 2%. So there's some stuff changing as we go forward here. Rates backing up are not having the same negative impact that they had a couple of months ago. And I think that's because earnings continue to come in better than expected, which goes back to our high nominal growth world point of view that, again, we've been expressing all year. When you have nominal growth of 8 to 10% and your earnings consensus bar is 2%, that's not a hard bar to beat.
So I actually didn't mention the title of your musings this week. It's things I don't understand. And I'm sure there's a lot of investors out there saying things like that. Like, I just don't understand this. Break down the things I don't understand, because I want to really hear what you don't understand.
Yeah, well, there are many things. My wife would tell you I don't understand anything. But it actually comes about from a conversation I had with a buddy who's in the business, a fellow macro guy visiting from out of town this week. And we were kicking stuff around, and I was like, damn, it's just like, I don't get some of the action. And he's like, well, what do you mean? And I was like, well, first off, European natural gas, right? One of my bête noirs. We've had a 70% pullback from the peak of the European natural gas scare. Remember, it was only a couple of months ago where people were saying, oh, Europe's not going to have enough energy for winter. Europeans are going to have to ration. They're going to be freezing. The lights are going to be off. And lo and behold, a couple of months later, we have natural gas prices down 70%, going down day after day. Here's a fun statistic for you, Scott. There are roughly 35 LNG carriers waiting offshore in Europe to discharge their LNG cargoes. There's not, the storage is so full that they can't unload these natural gas, the LNG cargoes. So that is a far cry from the fears that we had a couple months ago. This winter is going to be fine, basic bottom line. And yet, here's what I don't understand. When you have that kind of a move, you would think stocks and risk assets would respond positively because things are not going to be that bad. And that's what hasn't happened, right? The euro is lower than it was when nat gas prices peaked in Europe, which was late August. European stocks are down 6% from that exact date when the natural gas price peaked. And that's the kind of thing I don't understand. You have better than expected news flow, right? Clear price signals, better than expected, and yet your risk assets don't respond at all. So that's one example. Second example, another bet noir of mine is the airlines in the US, right? Jets, the ETF that represents the airlines. We've had it as part of our global multi-asset model, as part of our reopening play. And like a lot of things this year, it hasn't really worked out all that well, but we still hold it. And lo and behold, Q3, the numbers just came in, the airlines report early. Earnings were pretty good. In fact, the United Airlines CEO was quoted in their earnings call as saying Q3 was the best operational quarter ever. Ever. Where are jets? Jets are down 50% from the Q3 2019 level. And I referenced Q3 2019 because it's 2 years ago, or 3 years ago, pre-COVID, right? Yeah. And so when you're comparing like for like, even some of the financial metrics are better than they were in Q3 2019. And you have the CEO saying best operational quarter ever, and Jets is down 50% from that level, trading at about $16. It was over $30 Q3 2019. And then the last thing that, well, there are many other things I don't understand, but in the musings, the last thing I write about is not understanding how inflation seems to just keep levitating up at this 8% level, even though pretty much every input you want to look at suggests inflation should be falling sharply and soon. So you have the supply chain woes, right? Again, a year ago or earlier this year, there were over 100 ships waiting to unload off the west coast of the United States. Today, there are less than 5, okay? So supply chains clearly better. Gas prices down significantly, food prices down significantly, housing rolling over faster than in 08. I mean, we all know the story, and yet the inflation prints just keep getting higher and higher. So now we have a situation where you do see, very high quality names, Mark Zandi at Moody's, who I've paid attention to for a long time, JP Morgan, others, all saying that they expect inflation to be cut in half between where we are today and by the middle of next year. The Fed supposedly knows that you have a lag between when they raise or cut and the impact on the economy. And yet inflation still sticks at the 8% level. And the Fed still seems to be saying, we're going to tighten, we're going to tighten, we're going to raise, we're going to raise. And so I don't understand why that dynamic hasn't shifted yet, though I think we're very close, to that shift occurring.
Okay, well, I don't want to pick on you. It's like things you don't understand obviously gives a negative impression thing. So why don't you tell me about things you do understand?
Yeah, well, I had to get that in there to make myself feel better. I was writing this morning. I was like, God almighty, man, there's a lot of things I don't understand. What are people going to think? And so, yes, thank you for that. I do understand a few things. One of the things I understand is why stocks are basing and are in that two-sided market. Again, we've been kind of writing and setting this up for several weeks now. When you have a high nominal growth rate environment, as we touched on, 8 to 10% nominal growth, and earnings consensus are expected to be 2%, you should have earnings doing okay. And so far, earnings are doing okay, coming in The beats are about 70%. And what's interesting is that the forecasts, so, companies talking out end of year and into 2023 now, the forecasts are actually coming in better than expected. More companies are raising guidance than lowering guidance. And I think that also gives a good tone to the market. So I think I understand the earnings picture reasonably well. The other thing I think I understand, I think, and this is a little more tenuous, is that I do think this ever higher rate structure is approaching the end of its lifespan. That we're on fumes as we try to push the terminal rate above 5%. And I give you a couple of reasons why. And this is really just kind of cutting edge action today. First of all, we had Bullard, Fed Governor Bullard, talk yesterday, I believe, or the day before, and sounding quite like he's ready to kind of see how, let's get rates up to another 75 bips in November, maybe 50 in December. And then I think we're going to be in a position to pause. He actually talked about that as it pertains to 2023. And I would just note that 2023 is only 70 days away. So if the market is a forward discounting mechanism, what supposedly it is, we should be getting into that mindset pretty quick. And then today we had the Wall Street Journal reporter, Nick, whose last name I always massacre, but he's kind of seen as the Fed whisperer these days, just came out with a report this morning where basically saying the same thing. The Fed is starting to contemplate raising 75, and then that will be the end of the front loading, right, which we've been talking about for some time, and then seeing how the impact of their rate hikes to date impact the economy with that known 9 to 12 month lag. And so I think that's really, it's interesting. We've had the Fed whisperer come out. The Fed is clearly trying to send a message. Look, guys, we're getting ready to pause. We are going to raise 75, but that's going to be it. Then you have the BOJ clearly intervening in the dollar yen and the FX market today, taking the dollar yen from 151 to 147 in a matter of minutes. That's clearly somebody big stepping in there. So we're starting to get some central bank action here, pushing back a little bit against the market mindset, which I think is a good thing.
Well, there's a lot of pros and cons there, right? So when you add all of that together, what's that going to mean for the portfolio? Have we got any changes coming? Is there any big standouts we should be looking at?
Well, we update our models once a month, and you recall we have our global multi-asset model and our TPW 20 thematic model. And so we update at the beginning of every new month. And so that was just a couple weeks ago, sorry. And so we're not doing anything at the moment, but I do think that we are approaching the end of some of these trends, right? Which is what we've been setting up in our writing and in our model construction over the last couple months. We think we're pretty much at the end of the ever higher CPI prints. We think we're coming to the end of the Fed front loading. We think that means the end of the strong dollar move, where the dollar is way, way above its 200-day moving average. I think the furthest away from its 200-day moving average in something like 30 years. So when that rolls over, that rollover is probably going to be pretty meaningful. And we think that is going to drive action in the commodity space and in the non-US equity space. And we've touched on and have been building in our model, particularly our global multi-asset model, the opportunities that we see in emerging markets, particularly equities, but also currency and fixed income. So we have, over the last couple of months, built up positions across all three, equity, fixed income, and currency in the emerging markets, because we think the fact that EMFX has done better than DMFX over the last 6 months is that early canary. Usually when the Fed tightens and tightens aggressively, emerging markets gets crushed. That hasn't happened this time. And that, we think, is a signal we want to pay attention to. So I think, bottom line, we're getting more and more evidence that we're at the end of these trends of ever higher inflation, ever more aggressive Fed, ever stronger dollar, ever weaker stocks. We think we're approaching the turn. We're positioning for that turn. And we think investors really need to pay attention because it might happen as soon as over the next month or so.
Well, just one last little question before we finish up. Energy's obviously been the big winner this year, and it continues to be as well. Like when you see these things turn, do you think energy could be one that switches off or continues its move, what it's been doing?
Yeah, no, I think energy continues to be fine and should do well, right? If you have a dollar weakening, that should actually build demand for energy and for oil, right? When you think of oil is priced in dollars, most of the world is struggling because their currencies have lost value against the dollar. If the dollar rolls over, that actually cheapens oil in most other currencies. And so that should be a demand enhancer, which should be good for oil. So now we continue to be quite overweight energy in our global multi-asset model, and in our TPW20 model, quite focused on the climate opportunity set as we shift and toggle back and forth between continued need for fossil fuels and that inevitable shift towards clean energy, particularly as it pertains to both transportation with electric vehicles as well as power generation through the nuclear side, solar, wind, et cetera. And it's interesting, energy has done well, fossil fuels, XLE, et cetera. And the clean energy stuff has been hit pretty hard over the last month or two. So maybe there's an opportunity to look there. But for the most part, for us, we're holding both, and we have done so for several years, holding both traditional energy, XLE, AMLP, et cetera, as well as clean energy, things like KRBN, ICLN, and others, LIT for the transportation side. Those are all things that we have held for a while, and they're core positions. So we don't envision really moving away from any of that for the foreseeable future.
Okay, Jay. Listen, once again, a great chat. Learning more every week. We really appreciate your time, and you have a great weekend.
Thank you, Scott. You as well. Enjoy the kiddie ball. I think you're going to be fully booked this weekend, right?
Yeah, a lot of football and rugby on Sunday.
Awesome. Enjoy, my friend. Enjoy.
Thank you, Jay. And for everyone else out there watching, good luck investing.